Emmanuel Adeleke, an investment research analyst at ARM, now joins me from Lagos to discuss strategies for investing in the new normal. Emmanuel, glad to have you join us on Closing Bell West Africa. Give us a run through of what market activities within Nigeria's equity space have been in the week.
Yeah, so for the past this week, we've seen various sentiments across the markets. Although the market was up by about 0.57% today, the market still under the week down about 1.4%. And this is coming after the markets gained about 7% from last week. So it's just more of investors just taking out some profits. But the overall sentiment is still there. Investors are still quite bearish on the market. Foreign portfolio investors have left the market. The domestic investors are also showing apathy towards our markets. So in general, we still having the negative sentiments, and this has been as a result of this all happenings around the world, the COVID-19 pandemic, as well as in lower oil price, which has resulted into lower inflows into the country. So overall, it's just purely negative sentiment for the markets.
Now, speaking of purely negative sentiments, Emmanuel, are there specific areas where investors are seeing value at this time?
Yeah, sure. So in the midst of this whole negative sentiment, we see a list of stocks that I would believe are good buys. First of all, in the banking sector, we have specific news that we think that are good. First of all, at the start of the year, we saw the banks are threatened by CBN's tight regulations, which threaten their margins. Now, this whole COVID-19 and the lower price is also posing a big threat to them. However, I think we prefer banks that have adequate capacity or adequate buffer to withstand all these pressures. Basically, when you look at the list of banks that we think that might be able to withstand all these pressures, we have the likes of GT Zenith for the banks. GT Zenith, they have capital adequacy ratio over 22%. And when you do a stress test and we assume cost of risk go as high as 10%, you still discover these banks are still quite fine. They can still continue operations. In addition, both banks have better cost efficiency compared to other banks. And when you look at their dollar positions, also both banks, they have net dollar position in excess of over $1 billion, which makes them quite comfortable to book FX revaluation gains over the year. So in all, we favor the both banks. We have a target price of about 37 naira for GT, while we have a target price of 26 naira for Zenith. Then across, looking at going to other sectors, particularly the consumers, we've seen the same pressure also for the consumers sector, particularly the recent technical devaluation by the CBN, and also this restriction of economic activities also is going to definitely put a very big pressure on the consumer guys. However, we still prefer Nestle in the sense that Nestle source most of their input costs locally compared to other consumer companies. What that means is that this whole FX evaluation impact will really not really impact them that much. And aside that, they also have various good brands that spread across various consumer choice. So we like Nestle. So overall, we think looking at the whole situation and how things are going, we believe to be safe for investors to just stay on those specific names I mentioned. It is Zenith for the banks and Nestle for the consumer sectors.
Clearly, Emmanuel, so much going on there for the banking sector in Nigeria, and then interesting times for the consumer sector as well. I'm very happy that you talked about that now. When you look at the figures from last week to date for the consumer, that sector showed like the greatest difference in the week-to-date activities, up by some 15.57%, but still down year-to-date 34.78%. Now, when you talk about the pressure that the consumer goods sector is seeing compared with the buying power reported in the public, generally the sentiment about how weak the buying power is, what's the dynamic going on within that subsector?
So first of all, in the consumer space, even before this COVID-19 pandemic, the consumer sector they've been fixed with strict competition among the players, and that has been hampering sales receipts for most of the companies. And now we've seen this FX devaluation, which is definitely going to impact the input costs of most of these consumer companies. Most of them, they source their input cost from outside the country, and when they do that, they definitely have to source some dollar. When you also look at what's been happening also at the FX market, we've seen that the dollar liquidity has slowed compared to before. The CBN hasn't been intervening as much as it used to at both the NAFES window and also the SMIS window, and that's quite negative for most of these companies that definitely have to source dollars to import their input costs. And thirdly, we also have the impact of this COVID-19 on our economy. With less movement, less mobility now, you see all you get to see is that most of these companies don't get to sell as much volumes as they would before now. So that's basically what's been happening across the consumer sectors for now.